Hello everyone, welcome back. This is another update on what's going on with 3M. If you recall, I did an introduction video on 3M last year, back in July of 2023, and I wanted to do another important update as to what is going on with the company and why I think it is one of the very few deep value opportunities available in the market today. As the NASDAQ and S&P, set all-time new highs, breaking out to fresh all-time new highs earlier this year, with multiples, reaching well into the 20s now, and almost, touching 30 for the NASDAQ. The number of, true value opportunities out there are few and far in between, and I think 3M is presenting itself to be one of those few rare opportunities that we have in the market today. So let's get started as to exactly why I think it is a long-term deep value opportunity, as well as what has been going on in terms of recent events with the company. So let's get started with that. So just as an introduction, which I did last time in the video, if you haven't seen that video yet, that spends a little bit more time on the introduction of 3M as to what they do, to have a clear vision into what the company is involved in. But just to sum up, they have 4 primary divisions: safety and industrial, transportation and electronics, healthcare, and consumer. Consumer is really what we know them for, as well as some parts of healthcare too. They got a special they were especially, famous during COVID, during the pandemic, because everybody wanted their N95 masks. So 3M is the industry gold standard when it comes to, healthcare products like masks and other safety equipment that the medical professional world relies on. And here you can see a little bit of a breakdown as to what is included in each of these 4 sectors. What the consumer side is. We see them at Target and Walmart and other, stores throughout the country and throughout the world. Scotch-Brite, Post-it, sticky notes, command strips, Scotch tape. These are all brands that are owned by 3M. And then we have within the healthcare, sector, we have, these different types of products. Like Filtech. Filtech is used by dentists. That's, when you get dental fillings in your teeth, in your molar teeth, to prevent cavities. This is a, well-known, well-respected, and has been used for decades now, product by dentists. Also, they produce, bandages and gauze and other things like that. Again, this is ubiquitous throughout pretty much the world. Hospitals, clinics, doctors' offices, pharmaceuticals, they all depend on 3M products on an every single day basis. In the transportation side, they make industrial strength tapes. They also make industrial strength, polymers. This is used by railways. It's used by airlines. Boeing, for example, in the construction of their various, aircraft, use chemicals and adhesives and other products made by 3M and other companies as well. But 3M is, obviously right in the center of the transportation industry as far as electrical tapes, adhesive sealants go, and other things like that. And then in safety and industrial, there's the famous, N95 mask. Everybody really wanted that. The N95 was the gold standard for protection during COVID, and 3M is the worldwide trusted brand, producing these types of equipment. Also safety goggles and other things like that. So they produce together thousands of individual SKUs. So the total number of products are in the thousands. So again, 3M is ubiquitous throughout these 4 primary sectors. And that's because they have a core competency in chemicals. They are at their core a chemicals company, a chemical materials company, and then they have built brands on top of these chemicals. So obviously there's chemicals which can be commoditized, which they are, to a certain degree commoditized, but then they've taken the next step to brand these products and to build trust over decades of time, pretty much over a century, in the hearts and minds of consumers as well as professionals in the various industries that they serve. This type of goodwill only is built up by very few companies that have, strong and durable brands, such as what 3M has built over the last 100 years. Here you can see a chart of their price and earnings, and you can see the blue line is the price of 3M, and the price has come down dramatically from the top that we saw in 2018, which it got up to about $250 a share, and it's been in a straight downtrend since then. This is due to a number of different reasons, mainly slowing growth. That's pretty much the main reason. But then especially starting in 2021 and escalating in 2022, they've been hit by two major lawsuits. And we'll talk about exactly what those are and what's been going on with them. But as you can see, I'm just going to draw your attention real quick. In this entire 30-year history, you can only see 2 times in history where the price has intersected with the earnings line. You can see the earnings line is in the orange dotted line. When that happens, that means that the stock is trading at a PE of 10 because earnings are multiplied by 10 on this scale. So you can see this, the price and earnings on the same scale without throwing the scale off. So whenever the 2 lines intersect, that means that the stock is trading at a PE of 10. And then as the lines diverge from one another, that means that there's multiple expansion. And as the lines converge together, that means that there's multiple compression. And as you can see here from the top, there's been nothing but multiple compression. And now the stock is basically back to a 10 PE, which pretty much only has happened one other time, which was at the bottom of the 2008-2009 Great Financial Crisis. So 3M right now, if you were to use just traditional PE multiple analysis without even doing anything further than that, tells you that the stock is pretty much at an all-time low PE multiple relative to forward earnings. Now here's where I am getting excited because it's, you can be bearish because of, different reasons like, revenue slowdown and the litigation troubles that they've been through. But if you look at the core business, which is, again, going back to these 4 sectors, which are their core business. That's where their core competency has been. That's where the lion's share of their success over the last 100 years has come from, these 4 sectors. And if you look at free cash flow per share, which is the most important metric for any long-term investor, it's not earnings per share, it's not revenue. Ultimately, what matters to long-term investors, equity holders, is free cash flow per share and the growth of that number over time. Because as this number grows, it basically affords the company increasing optionality as to how to return that capital back to shareholders in the form of dividends or share buybacks or acquisitions that boost growth or allow them to vertically integrate or to generate other forms of increasing ROIC through those acquisitions. It just creates a lot of optionality for the company to add value to shareholders. So free cash flow per share growth is the most important metric that we should be focused on. And that number has been in a free fall since the top of 2021. Remember, this is the bump that they received due to COVID, where free cash flow per share went well above trend. And now we've kind of crashed, to trend and then thereafter below trend. But you can see what's been going on in the last year, almost 2 years now, where free cash flow per share has now rebounded well off the trough here and is in a very, very strong upswing, back to long-term trend. So, this entire drawdown of free cash flow per share, I don't think that that's significant because of what they had to go through during COVID. Remember, there was extraordinary demand for their products, as a result of the pandemic. That required them to boost output. But then as the pandemic eased, They had a lot of excess supply, a lot of excess inventory. That excess inventory starts to work against you in free cash flow, right? If you know if you are familiar with the underlying calculation there. And so with that excess inventory, you see this big drawdown in the free cash flow. But I believe that the bottom is now in where, supply has now caught up to, or, caught down really to demand. Demand is back to where it has been over the long term, right? This is the trend growth is what we're interested in. And so now we can see that free cash flow per share is inching back to the long-term trend growth rate that it's always been on. That's the trajectory that we'd like to see the company on. So I believe that this chart is telling us that the core business is strong and profitability is now on the upswing in terms of both margins and raw dollar amount in terms of the free cash flow per share dollar amount. And here you can see the other side of the coin, which is also very important. Just as I mentioned, that free cash flow per share is the most important metric. Return on invested capital is probably the second most important metric. We're possibly even tied in terms of the most important metric. We can debate that back and forth, but ROIC, if you've been following my webinars over the years, this is probably the first or second thing I look at when it comes to evaluating a company. Free cash flow per share growth and return on invested capital. That tells you how profitable is the company. How efficient are they in allocating capital to earn returns that exceed the cost of capital, right? If you don't generate returns on capital that exceed your cost of capital, then you deserve a very low PE multiple. And that's why banks, for example, are always at low multiples. That's why automakers like GM and Ford are always at low multiples, because they are businesses that earn very low returns on capital. And when that happens, you don't actually create a lot of value in the long run because the cost exceeds what you're generating, right? So if it costs you 5%, let's say for example, to access capital in the capital markets between debt and equity, and if you're using that 5% cost of capital and earning a 4% return on capital, then are you really creating value? Even if you grow, you're not actually creating value for shareholders or debt holders for that matter. So in that case, the market will not reward any growth that comes from that, unless if there is an expectation that the ROIC will eventually move up above the cost of capital. But in the long run, you want to see evidence that the company is able to and can sustainably produce high returns on capital relative to the cost of capital. And here on the left-hand side, you can see that the company has very consistently done that. Now, it has had some volatility where it has come up to 20%, crashing all the way down to 12%, rebounding a little bit, coming back down. But that's not something that I would be too concerned over because the number itself can be volatile. But the key is that is it high and is it sustainably and consistently higher than the cost of capital? For most companies, I would say the cost of capital is around 8%. That's a general rule of thumb that I like to use. And 3M is well in excess of that at 12%. So that's very important to look at. So the core business continues to fetch attractive returns on invested capital. Now, let's get to the core of the sort of the crux of the problem. Here's a summary of what they've been going through these last 2 years now. There are two major lawsuits that they have been battling. One is what they call public water systems. These are the public water systems of multiple states, especially California, but also many other states too, like Maryland and Illinois. Many attorney generals of various different states have filed lawsuits against the company for its usage of what they call PFAS. I'm not going to try to even pronounce what that stands for because it's a very long chemical compound, but it's also known as forever chemicals. These chemicals are used in products like fire retardants. Again, remember 3M, who are they? At their core, they are a chemical materials company. And then they've taken these their expertise in chemicals and have branded them into long-lasting, durable brand equity. But again, in their fire retardants, for example, in their non-stick cookware, which many different cookware manufacturers rely on, is that non-stick material that's coated onto many different types of cookware, like pots and pans. These attorney generals have alleged that these PFAS chemicals, which are used in fire retardants, non-stick cookware, many other personal products as well, allege that these chemicals have spilled into the environment and have also caused significant health damage with links to cancer and this is what the lawsuit alleges, 98% of California's approximately 39 million people. So, whether it causes damage or not, I don't know. That's not my area of expertise at all. But the EPA has provided guidelines against that, and 3M, as a result, has agreed to essentially phase out all usage of PFAS chemicals by 2025. So that's what they've already committed themselves to doing. And in order to settle these, various lawsuits, 3M has agreed to pay nearly $12 billion in damages to settle this and put it behind them once and for all. So there is that. That's the big one. Then the second biggest, which is still quite big, but not as big, this is the Combat Arms Earplug, CAE. This is another class action lawsuit, just like the Public Water Systems class action lawsuit. This is coming from several thousand U.S. military servicemen and women, alleging that the company's earplugs, remember, again, the company has such an expertise in chemicals that the applications to these chemicals are vast. So the company makes earplugs, for example, if you have seen them, those squishy foam earplugs. These plaintiffs allege that these earplugs were defective and therefore led to hearing loss from repeated exposure to loud sounds such as gunfire while deployed in combat or in training. And so therefore, because of that lawsuit, 3M has agreed to settle this dispute at a price tag of $6 billion. So combined, if you add up everything between the settlement amounts plus all of the litigation fees, the legal fees, the court fees, the total amount that they are on the hook for with these two lawsuits is close to $19 billion. And that is a very, very large number. The company does not have $19 billion in cash lying on the balance sheet. This is not something that they can just cough up and it's just an afterthought. Like if you look at Apple or Google or Microsoft, they could pay 5 times this price and still have cash left over. 3M is not that cash rich. They only have about $5 to $6 billion in cash as of Q4. And this is a price tag of $19 billion total. But the good news is that the majority of these settlements will be paid over 13 years, according to the annual 10K that they published. They will be annual payments spread out over 13 years. So it won't be all up front. So when that happens, that's obviously very, very good for the company's liquidity position. It's not going to force them to dilute shareholders significantly or at all. It's not going to force them to tap into even more debt than they already have. They have about $16 billion in debt right now. That's another concern. We'll talk about that in a minute. But it's not, because it's spread out over 13 years, they're not going to have to dilute equity holders, and they're not going to have to leverage the balance sheet even more than they already are. Because, as we saw here, they are free cash flow positive. The company is still free cash flow positive and growing at trend growth, which is around 7% per annum. That is very, very bullish. So again, this tells you that the company can pay all of these settlements from their free cash flow. And again, still have money left over to sustain the dividend. We'll look at the math in just a minute here. But remember, this is a company that has has paid a dividend now for a century, 100 years. And they are also a dividend aristocrat. So a lot of fears were swirling out there that they're going to have to cut the dividend and therefore lose their dividend aristocracy status. But I think that the math is going to allow them to continue. That's why I think this is such an interesting value opportunity right now. So keep this in mind. These settlements, these $19 billion of settlements, are going to be spread out over 13 years. So they will be able to pay this off gradually out of their free cash flow. So it's expected to support the company's liquidity position. Now, here's the other part of it. They had already had plans to spin off the healthcare segment. So remember, going back to their healthcare segment, this is what it looks like on the bottom left. This is the segment that they're spinning off. And that is expected to raise $7 billion of a one-time dividend from the new spin-off entity. And they will also get an additional $3.5 to $5 billion over time once that spin-off is completed. So the total proceeds are expected to be, north of $10 billion over the next 2 to 3 years. Once immediately after the spinoff is complete, which is still on track to happen this year. So that will generate a one-time dividend to 3M in the amount of $7 billion. And then another $3.5 to $5 billion over time as they, hit certain milestones that they have yet to reveal, but we will see that coming up shortly here. They will still retain 20% ownership of the new spinoff. So even though they're losing a valuable asset, they are still retaining 20% ownership. So that will allow them to continue to tap into the benefits of that specific sector. But the reason why this is bullish is because it's expected to unlock value. Because the healthcare segment is unlike the other three segments that they have. Because the healthcare segment is the one part of the business that is unaffected by recessions. Remember, the demand for healthcare products rarely ever goes down, no matter what's happening. Whether it is higher interest rates or low interest rates, whether it is recession or boom time, that is an aspect of the business that has very steady, revenue and earnings growth. And because the company now trades at a 10 PE, right, as a total, which includes the healthcare segment, if they spin off that healthcare segment, and if the company gets anything more than a 10 PE, then that means that the spinoff is unlocking value because investors value that segment more than the aggregate company itself. Meaning investors want to pay a higher multiple for that segment, but they don't want to own the other assets of 3M as much as the healthcare segment. So that spinoff is expected to unlock value by fetching something closer to a 15 to 20 multiple on that segment's earnings. So that is a very, very powerful value that the company is able to unlock. Now, they're also in the midst of restructuring plans. They have already announced 6,000 employees are going to be laid off worldwide. They've been working on supply chain simplification. They prioritize high growth markets, other cost-cutting measures. So in the Q4 earnings, which just came out, the company reiterated that the net impact of all of this restructuring should be accretive to operating income by about 700 to 900 million in 2024. So that means growth in EBIT by 700 to 900 million this year. Now, on January 22nd, this is another very important thing. Fitch Ratings assigned an A- rating on 3M debt, specifically, rate with an outlook stable rating based on expectations of 6.5 billion EBITDA this year, mid 20% EBITDA margins, $4 billion in free cash flow before settlement payments and dividends. That's, again, very, very important. This means that they are actually assuming that free cash flow will actually go down this year. So taking a cautionary stance even if free cash flow declines to $4 billion, they're still getting that A- and an outlook stable rating. I believe that they're going to exceed that 4 billion free cash flow estimate quite, easily. I think it'll be closer to 5 billion this year, probably more. But in addition, like I said, a 7 billion one-time dividend from the new healthcare spinoff. It's called Solventum. And then another 3.5 to 5 billion additional proceeds from the sale. This is going to be huge to shore up the balance sheet. And so overall, Fitch expects the company to sustain and move past this $19 billion hit from these two lawsuits. And very important to keep an eye on. Here's their full year guidance for this year. They're guiding for flat to 2% organic sales growth. So remember, organic is key because it tells you how the core businesses are doing outside of any other one-time impacts like FX or other temporary issues that aren't repeatable. This is an improvement from last year because remember, at this time last year, they guided for flat to minus 3% sales growth. This time it's flat to plus 2% sales growth. So that's going to be, again, very important. Remember, even small numbers like this is going to be huge to be able to shore up the company's balance sheet. So any growth on the top line is going to lead to operating leverage at the bottom line, and therefore compound free cash flow and earnings for the coming year. Adjusted earnings per share of $9.35 to $9.75. That was slightly below analyst estimates, and that's why the stock actually dropped about 5% post Q4 earnings. But here's what I love here. I love it when management actually brings your attention to free cash flow conversion. This is the ultimate metric for assessing earnings quality, and that's expected to be somewhere between 95 to 105%. That's a very beautiful number. Tells you that, there's high quality behind these earnings that they're telling you. So my primary conclusions, this is a company that has stable forward core business organic growth at the top line. They're exhibiting now stabilizing adjusted margins, high quality earnings with that, strong free cash flow conversion. It's trading at a deep value multiple at 10 times forward PE. The company now trades at a 6.5% dividend yield, which I believe is supportable by the company's core free cash flow. And this is why I think, all of these things combined, I believe that this is a very, very interesting long opportunity to own one of the most iconic and long-standing, time-tested brands in the entire US, 3M. And here you can see that this is a chart of historical revenue growth. Obviously it's well below trend. That's one of the reasons why the stock has gotten so cheap. But as you can see in the dotted line, there is a revenue growth recovery expected this year, again, based on management's guidance and based on core trends in the underlying businesses themselves. Here's the adjusted net margin stability, stabilization, and recovery. Again, we have to look at adjusted. If you look at GAAP net margins, it's going to look like the company is bleeding cash, which they have. I mean, they have, that was a big hit. They have definitely spent a lot of money on litigation expense. But remember, these are not long-term expenses. If you view them as one-time expenses that won't be repeatable forever, then if you look at the pro forma adjusted net income, that's where you can see where the value is being created here. So if you adjust out those one-time items, you'll see that the company is generating still well above 15% net margins. That's, again, very, very attractive. And now here's the, talk about the dividend. A lot of people thought the company will have to cut the dividend. But look at this right here. Right now, they pay about $6.04 of dividends per share. And the free cash flow per share is at $9.33. And that's despite the fact that it's, well off the all-time high here, which was set in 2021. So again, free cash flow well covers the dividend. And yet look at the dividend yield at the very bottom chart. This is now trading at the highest yield ever at well above 6.5%. So this to me is a very interesting, again, a very attractive opportunity. A 6.5% yield for a company that I believe is going to be able to support that dividend quite easily, especially because, like I mentioned, the settlements are going to be phased in over time, over a 13-year period. It's not going to wreck the balance sheet because of that reason. And even if you look at the balance sheet really isn't that atrocious. A lot of people are worried about 3M's leverage ratios, but if you look at net debt to EBITDA, this is really pretty much in line with what you see in industrials right now. Net debt to EBITDA on a trailing basis is at 2 times. That's a 2x leverage ratio versus the industrials sector average at roughly 2.3 times. So this to me is not that concerning. Although, the leverage ratio has increased over time for 3M, relative to the sector average, it's really not that bad. Now, if you look at the balance sheet here, you can see that the cash balance as of Q4 is roughly $6 billion. They have another $4.7 billion in receivables, but let's just take the cash itself at $6 billion face value. The current debt, meaning debt that's coming due within the next 12 months, is under $3 billion. So even if nothing else happens, let's say free cash flow goes to zero, right, which is highly unlikely, but let's say that happens, they would still be able to meet and service the current debt that's coming due just out of the cash balance that they have. Long-term debt is still a question, or still a concern, but again, at $13 billion plus another 3 current, that's a total of $16 billion. They're generating at least remember this based on Fitch's expectation, which is already conservative to begin with. Fitch believes, if you go back, that they will do about $4 billion in free cash flow this year in 2024. So if they have $16 billion in total debt and $4 billion in free cash flow this year, that's total debt to free cash flow of only 4. So in 4 years, they could extinguish all of that debt, right? Just out of their free cash flow, which, obviously they're not going to do because they have settlements to pay. That takes, that probably takes precedent over paying down the debt. So what they will most likely do is refinance the debt. And they may have a little bit higher interest to pay on that. But as you can see here, the leverage ratio is what's most important. The leverage ratio, net debt, again, that's total debt minus cash on the balance sheet divided by EBITDA. EBITDA is important because that's a number that is important to bondholders because that represents cash flow to firm, which it represents the amount of money that's available in order to make debt service payments. And so as long as that number is, manageable at 2 times, that's really not that concerning to me, at least. So again, with a company with positive free cash flow, $6 billion in cash, plus remember that $7 billion of a dividend once that healthcare spinoff is complete, again, that's going to give you a very strong balance sheet from which they can begin to make these settlement payments and put that chapter behind them. Now, here's where the value opportunity comes from. Shares now trade at the lowest multiple to normalized earnings in decades. This is the Schiller PE. This is why I'm getting very bullish on the stock, because it is now at depressed levels, despite the fact that this is still a growing business. This only happens, the only time where shares get this cheap is when you're investing in a dying business, or when you're investing in a business that is being disrupted, or when you're investing in a very low ROIC business. But none of those apply to 3M. This is still a growing business on the top line. It's still a growing business on the bottom line. It's still a business that produces 12% returns on capital. It's still a business that produces 15% adjusted net margins. It'd be very hard to find another company with those characteristics trading at a PE this low. So again, the forward PE, just like the Shiller PE, the forward PE, the more traditional PE, is now at the lowest levels in modern history. So again, the combination of a world-class consumer brand, a business that is recession resilient, a very strong core business, and a deep value multiple is setting up for, in my opinion, a tremendous buying opportunity to achieve outsized returns over the next 3 to 5 years as the business stabilizes and gets back to modest growth targets of 2 to 5%. So my price target, by December of 2028 is $200. That's more than a doubling from today's price. That's a 16% IRR, plus a 6.5% dividend yield. So combined, you're going to get, I believe, a 22.5% per year total return on shares of 3M. Again, this is a Dow component. This is not a untested, startup. This is a company that has built a reputation over a century of time, where people continue to depend on the products irrespective of what happened from these lawsuits. So really the only thing that really needs to happen, because the shares are so cheap, you really don't need a lot of growth to get to this price target. All that needs to happen is 3 things. The company needs to settle and move past these controversies. Organic growth returns to the 3% range per annum. That's 3% top line growth, 5 to 7% bottom line growth, and operating margins stabilize around 20%. I believe it's very likely that 3M achieves these targets. For a business like them, 2 and 3 are very likely. The biggest question remains on number 1. And it looks like, based on management commentary and based on what we have seen and heard in the media and the press and on the earnings calls, it looks like they are going to be moving past number 1 because the settlement has basically been, or most likely has been, approved, and that's what's going to be happening going forward. So hopefully you found this helpful. We will do another follow-up on this in maybe about 6 months or so. Let's see how this prediction is going. But I'd love to hear from you if you have any questions or feedback, or if I missed any particular details on what's happening. I'd love to hear critical feedback or any type of feedback whatsoever from you. You can reach us at zrs@zacks.com or zat@zacks.com. Or give us a call at 1-866-794-6065. Thanks, everyone. Talk to you soon. Bye.